Okay, let's unpack this. We talk a lot about dreams on this show. We talk about the dream of, financial independence, the dream of building a legacy.
Retiring early to a vineyard in Tuscany.
That's the one. Exactly. But, usually when we talk about the specific dream of homeownership, the conversation gets very aesthetic very quickly.
Oh, wow.
We get bogged down in finding the perfect kitchen island or making sure it's in the right school district or arguing about whether an open concept living room is actually a good idea. But today
Today is different.
we're going to look at the gatekeeper.
The gatekeeper.
Yeah.
That sounds incredibly ominous.
It is a little ominous. I mean, think about it. You can find the house, you can haggle the price with the seller until you're blue in the face.
You've already mentally arranged your furniture.
Yes, you've picked out the paint colors. But there is a single number, a ratio, really, that stands between you and the keys. It determines if you get the loan, how much that loan costs you in the long run, and frankly, how much sleep the bank manager loses over you at night.
You're talking about the loan-to-value ratio, the LTV.
Exactly. The LTV. It sounds like just another boring financial acronym, right? The kind of thing you just skim over in the paperwork while your hand is cramping from signing 30 documents. But as we went through the research for this deep dive, and we have a massive stack of sources here. I mean, banking regulations from the US, the UK, Australia, and New Zealand, plus some very dense risk assessment guidelines. It became pretty clear that this isn't just a number. It's the intersection of math and dreams.
That's a poetic way to put it. I'd say it's the intersection of math and risk.
Well, from the bank's perspective, sure. But for the listener, this is the metric that decides if they did to participate in the economy or not. I mean, it's the ratio that compares the size of the loan to the value of the asset securing it.
Right.
And today we are going to decode how lenders use this number to judge you, while 100% isn't always the limit, and how different countries, they actually manipulate this number to control their entire economies.
It really is a fascinating metric because it strips away a lot of the emotion of buying a home, and it reduces it to a measure of leverage. It's all about how much skin you have in the game versus how much exposure the bank has.
Right.
And while that sounds simple, the implications are just massive.
Massive. And I want to be really clear about our mission today. We aren't just defining a term here. We are going to look at the valuation trap, which I think is going to make some listeners, angry.
It can be frustrating for sure.
And we're going to look at why banks sometimes prefer a borrower with bad credit who has a low LTV over a pristine borrower with a high LTV.
Which is a paradox that trips a lot of people up. It seems completely backwards.
It really does. So let's dive into the anatomy of the number. Segment 1, let's just strip away all the jargon. What is the basic formula we are working with here?
Okay, so at its absolute core, the LTV ratio is a division problem. It's really that simple. It is the calculation used by banks, building societies, credit unions, basically anyone lending money to quantify their exposure.
Their risk.
Exactly. You take the first mortgage line, that's the primary loan amount you were asking to borrow, and you divide it by the total appraised value of the property.
Okay, simple division. But I want to make this really concrete because percentages can get abstract and we all kind of glaze over.
Yeah.
Let's walk through the specific scenario from the source material.
Sure. Let's say you are looking to buy a home. It's a modest place, listed at $150,000. And let's just assume for a second that the value is, in fact, $150,000.
Okay, so the denominator in our equation is 150 grand.
Right. Now, like most people, you probably don't have $150,000 in cash sitting in a duffel bag under your bed.
I wish.
We all do. So you have some savings, but you need to borrow the bulk of the purchase price. You go to the bank and you ask to borrow $130,000.
So borrowing 130,000, the asset is worth 150.
Exactly. So the calculator comes out. You take 130,000, you divide it by 150,000, and the result is 0.86666. It goes on. So we just round that up.
To 0.87.
0.87. Which gives us an LTV of 87%.
So I'm financing 87% of the home's value. That's it. That's my score.
That is your risk score, essentially, yes.
Now, simple math tells me there is a remainder there. There's 13% left over. In this scenario, that's the $20,000 I presumably put down as a down payment. But the source material used a term for this that I found really interesting. They called it the lender's haircut.
Yes, the haircut. It's very common finance speak.
It sounds like a bad salon experience. I went to the bank and got a terrible haircut. But why use that term? What does that even mean?
Well, in broader finance, a haircut refers to the difference between the market value of an asset and the value ascribed to it for collateral purposes. It's a reduction. But in the mortgage world, just think of it as the buffer.
The buffer.
That 13%, your equity, that is the lender's safety net. It represents the haircut off the total value that the lender doesn't have to worry about losing if things go south.
So the haircut is basically the bank saying, you take the first hit.
100%. That is exactly what it is. If the house burns down or, more realistically, if the housing market crashes and values drop by 10%, that loss comes out of your $20,000.
Not theirs.
The bank's $130,000 is still theoretically safe because it's covered by the remaining value of the home.
So the bank is using my money as a shield for their money.
That is the fundamental nature of a secured loan. Your equity is the shock absorber. And this establishes the fundamental rule of LTV. There is an inverse relationship between the LTV ratio and the lender's risk.
Walk me through that relationship. I think I get it, but spell it out.
It's simple, really. The higher the LTV, meaning the closer that ratio gets to 100%, the lower the equity you have in the deal. The lower your equity, the smaller the haircut or buffer.
And a small buffer means?
A small buffer means the loan is much, much riskier for the bank.
Because if I have an 87% LTV, I have 13% skin in the game.
Right.
If things get tough, I'm going to fight to keep that house because I don't want to lose my 20 grand.
Right.
But if I had, say, a 99% LTV...
If you have a 99% LTV, you have almost nothing to lose. If the market drops just 2%, you are suddenly underwater, meaning you owe more than the house is worth.
Oh, wow.
At that point, historically speaking, borrowers are much more likely to just mail the keys back to the bank and walk away.
That's the strategic default concept we heard so much about in 2008.
Exactly. So the bank wants that haircut to be as deep as possible to prevent you from walking away and to ensure that if they have to foreclose and sell the house, the sale price covers the debt.
Okay, so that's the numerator and the denominator.
Mm-hmm.
Loan amount divided by value. But here's where I want to push back a bit, because the value part of that equation feels slippery. Well, value. According to whom? If I agree to pay a seller $150,000 and they agree to sell it for $150,000, isn't that the value? I mean, that's the market price. That's capitalism.
In a philosophical sense, yes. The value of a thing is what someone is willing to pay for it.
Right.
But banks are not philosophers. They are risk managers. And they operate under a very specific rule called the lesser of.
Ah, the valuation trap.
Right. The rule states that banks will utilize the lesser of the appraised value or the purchase price. And this assumes an arm's length transaction, meaning you aren't buying it from your brother for $1 or something.
So let's play this out. I get into a bidding war. The house is listed for $140,000. I really want it. I bid $150,000. The seller accepts. We sign the contract. I'm happy. The seller is happy. Everyone's happy.
But the bank is skeptical. They send an appraiser out, a third party with a clipboard and a database of comps, or comparable sales. This appraiser looks at the house and says, you know what? I see the contract says $150, but the house down the street only sold for $140. This roof is old. I appraise this house at $140,000.
This is the nightmare scenario for a buyer. Because now the value in your LTV calculation isn't $150,000 anymore. It's $140,000.
Correct. The bank ignores the price you agreed to pay. They look at the appraisal. End of story.
But I still need to borrow the money to pay the seller the $150,000 we agreed on. I mean, the seller doesn't care what the appraiser thinks.
That's your problem, not the bank's. The bank says, we're only comfortable lending against the value of the collateral. If they lend you money based on the $150,000, but the asset securing it is only worth $140,000, well, their risk profile just skyrocketed.
So what happens to the math? What does that do to my LTV?
Well, let's look at it. You wanted to borrow $130,000. If the value is $150,000, that's 87% LTV. We established that.
Right.
But if the value is suddenly $140,000, $130,000 divided by $140,000 is roughly 93%.
That's a huge jump.
It is. And that jump might push you into a bracket where the loan is just denied, or the interest rate is higher, or the mortgage insurance premiums double. It changes everything.
So I'm just stuck.
Unless you have cash. Usually this forces the borrower to pay the appraisal gap out of pocket. You have to come up with that extra $10,000 in cash to bring the loan amount back down to a comfortable LTV for the bank.
It feels like the bank is saying, heads we win, tails you lose. Because let me ask you this. What if I get a great deal? Say I'm a great negotiator
Hmm.
and I buy that $150,000 house for $130,000. Does the bank use the 150 appraisal then?
No, absolutely not.
I knew it.
If you buy it for 130,000, they use the purchase price.
See? That feels rigged.
It's conservative. It's just pure risk management. They always choose the number that results in the highest calculated risk or the lowest value just to be safe. They use the lesser of to protect their haircut. They assume that if you bought it for 130, well, maybe there's something wrong with it that the appraiser missed, or maybe that's just the true market value now.
Okay, so we've got the formula. We understand the trap. Now let's talk about the magic number. The source material keeps circling back to this pivot point, 80%.
The 80% rule. This is really the industry standard line in the sand.
Why 80%? I mean, is there something magical about having 20% equity? Or is it just a nice round number that bankers like?
It's largely historical and statistical. Lenders have mountains of data going back decades through booms and busts. That data consistently shows that the likelihood of a lender absorbing a financial loss is directly tied to that equity buffer. And at 80% LTV, meaning the borrower puts 20% down, the risk of default resulting in an actual loss for the bank just drops significantly. It's a statistical cliff.
So below 80% is the safe zone.
Correct. Low LTV. In this zone, the bank breathes easy. You generally get the best interest rates here, the best terms. It's where you want to be.
But being in the safe zone creates a really weird dynamic. This was one of the most surprising things in the notes for me, the paradox.
Yes. The source says, and I'm quoting here, low LTV ratios allow lenders to consider higher risk borrowers.
Hang on, that sounds completely backwards. If I have bad credit, maybe a few late payments, or my debt-to-income ratio is a little high, or I'm self-employed with messy tax returns, I'm a high-risk borrower. You would think the bank would want more proof from me, not less.
You'd think so.
But the source says if the LTV is low enough, they might just ignore all that.
Think about it from the bank's perspective. Let's say you are a wealthy individual with a very complicated income stream. Maybe it fluctuates wildly. Your credit score is mediocre because you missed a few credit card payments while traveling internationally. But you want to buy a $1 million house, and you are putting $400,000 down in cash.
So I'm borrowing $600,000 on a $1 million asset.
Right.
That's a 60% LTV. I'm deep in the safe zone.
Exactly. Now, does the bank really care if your income is sporadic or that you missed a Visa payment?
I guess not.
They don't.
Oh.
Because even if you default, even if you never make a single mortgage payment, the bank can foreclose, sell the house for a fire sale price of, say, $800,000 just to get rid of it quickly.
And they still get their money back?
They pay off the $600,000 loan, cover all their legal fees, and still have $100,000 left over. The asset covers the risk.
The asset covers the risk.
Precisely. This is why no-doc or low-doc loans exist. These are loans where you provide very little documentation about your income. They are only possible because the LTV is so low.
So it's cash covers character.
That's a perfect way to put it. If you lower the LTV enough, you can bypass a lot of the character flaws in your credit report. The bank is lending to the house, not to you.
But then we cross the line. We go above 80%. Into the danger zone.
High LTV. Anything above 80%. Now the dynamic flips completely on its head.
Right, because the source says that, contrary to the low LTV scenario, high LTV loans are primarily reserved for borrowers with higher credit scores.
It makes sense, doesn't it? If you are borrowing 90 or 95% of the home's value, the bank has almost no buffer. Their haircut is just a little trim.
If I stumble, they fall?
Exactly. So they need to be absolutely certain that you aren't going to stumble.
So they stop looking at the asset and they start looking at the person.
100%. They need to see a pristine payment history, a solid job with tenure, high credit scores, low debt. They can't rely on the equity to save them, so they have to rely on you. You have to be the safety net.
And even then, even with the good credit score, they don't trust you completely. Because this is where MI comes in.
Mortgage insurance.
The bane of every first-time homebuyer's existence.
It is the cost of doing business above 80%. The source is very clear. Lenders require borrowers of high LTV loans to buy mortgage insurance to protect the lender from the buyer's default.
I want to highlight that phrasing because it's so important. I pay the premium, which can be hundreds of dollars a month, but the insurance protects them. If I lose my job, that insurance doesn't pay my mortgage, right?
No, it does absolutely nothing for you. It's not for your benefit at all. It protects the bank's haircut. It basically insures that top 15 to 20% of the loan. If you default, the insurance company cuts a check to the bank to cover the loss.
So that's why they're willing to do it.
That's the only reason banks are willing to lend 95 or 97% on a home. Without MI, the risk would be mathematically unacceptable to them.
So it's the price of admission. If I don't have the 20% down, I have to pay the insurance company to take the risk on my behalf.
Correct. You're paying to make yourself look like a lower risk borrower on paper.
So we have the safe zone, which is less than 80%, the danger zone, over 80% with MI,
Right.
but the source mentions the extremes.
Right. 100% LTV. Full financing.
The holy grail for first-time buyers.
Mhm.
Who actually gets this? Is this a real thing?
In the private market, almost no one. The source notes that 100% LTV is reserved for only the most credit-worthy borrowers. You have to think ultra-high net worth individuals where the bank holds their other assets, their investment portfolio. For normal people, 100% financing is a unicorn, unless, as we'll see later, you have some government help.
And then the nightmare scenario, greater than 100%.
Underwater mortgages.
This sounds like a physics problem. How can the loan be bigger than the house?
Well, it rarely starts that way. It usually happens after the fact. You buy a house at 95% LTV, the market drops 10%. Suddenly, you owe $190,000 on a house that's only worth $180,000. Your LTV is now roughly 105%.
You're underwater.
You're underwater.
And why is this so dangerous? I mean, if I can still afford the monthly payment, does it really matter if I'm underwater?
It matters immensely if you need to move. If you get a job offer in another state, or you get divorced, or you have triplets and need a bigger house, you can't sell.
Because if I sell for $180,000, I still owe the bank $10,000.
Plus closing costs. So you'd have to write a check for maybe $20,000 just to get out of the house. Most people don't have that. So they are trapped. They are prisoners of their LTV.
That is a terrifying place to be. But you know, life isn't always as simple as one house, one loan.
Yeah.
Sometimes we stack debt. And this brings us to the next layer of complexity in our outline, the CLTV.
The combined loan to value.
I like to think of this as the layer cake of debt. Because in the real world, people don't just have a mortgage, they have a second mortgage. They have a HELOC.
Right. The CLTV is the proportion of all loans secured by a property in relation to its value. The key word here is combined, or sometimes you'll see cumulative. It's the same idea.
So let's walk through the math of multiple liens. A lien basically being a legal claim on the property.
Correct. A mortgage is a lien. A second mortgage is a lien. A tax judgment can be a lien. It's a claim.
So scenario A. I have a $100,000 house. I have a single mortgage for $50,000. My LTV is 50%. Easy. Safe.
Very safe. The bank loves you, your model client.
Now, scenario B. Same house. $100,000 value. I have that first mortgage of $50,000. But I decide I want a new kitchen. I want those granite countertops we talked about. So I take out a second mortgage for $25,000.
Okay. So now, a bank looking at your risk profile, maybe you're trying to refinance or get another loan, doesn't just look at the $50,000. They have to look at the aggregate balance.
The total.
$50,000 plus $25,000 equals $75,000 total debt secured by that house.
So my LTV might be 50% on that first loan, but my CLTV is 75%.
Exactly. And that CLTV is the real measure of your leverage. If you default, the sale of the house has to pay off both of those debts. The second mortgage holder only gets paid after the first is made whole.
But there's a sneaky one in here, the HELOC. The home equity line of credit. This is like a credit card secured by your house, right?
It is. And it complicates the math because a HELOC has a balance, what you owe right now, and a limit, which is what you could borrow.
The source gives a specific example. A $100,000 property, a $50,000 first mortgage, and a HELOC with a balance of $10,000.
So you add it up. 50,000 plus 10,000 divided by 100,000. That's a 60% CLTV.
But wait a second. What if my limit on that HELOC is $40,000? I only owe $10,000 today, but I could go buy a boat tomorrow and max it out. Does the bank care about that potential debt?
Yes, they do. A very conservative lender will. That's often called the HCLTV or TLTV, total loan to value. Some rigorous risk models assume you will max out your credit lines. Because if things get tight financially, what do people do?
They use all their available credit.
They draw down every cent of credit they have. So that potential debt is a real risk.
So hidden debt is a killer in risk assessment.
It is. The takeaway is that to measure the true riskiness of the borrower, you must look at all outstanding debt, not just the primary mortgage. It's like looking at an iceberg. The LTV is the tip, but the CLTV is everything lurking underneath the water.
So we've dissected the number, we've looked at the trap, we've stacked the loans. Now, I want to zoom out, because what I found fascinating in reading through these regulations is that LTV isn't a universal language. I mean, the math is the same, but the rules change wildly depending on which country you're standing in.
It really does. Different nations use LTV for different purposes. In some places, it's just a private bank rule. In others, it's a government weapon.
Let's start at home, or at least the biggest market in our source material, the United States.
The U.S. is interesting because it's a mix of private and public rules. You have the conforming loans. These are the ones that meet the guidelines set by Fannie Mae and Freddie Mac.
The two government-sponsored enterprises, the giants of the mortgage world.
Right, and their guideline is pretty strict on that 80% pivot point we talked about. They will generally limit the LTV to less than or equal to 80% without insurance. If you go above 80% on a conforming loan, you must have private mortgage insurance. It's not really a choice.
It's a requirement to sell that loan on the secondary market.
Precisely.
But the U.S. has this whole alphabet soup of government exceptions, right? And this is where the U.S. government basically steps in to break the rules of risk we just spent all this time discussing.
Yes. It's a policy choice. The U.S. government has decided that homeownership is a social good. So they created agencies to absorb risk that private banks won't touch.
Let's talk about the FHA, the Federal Housing Administration.
They insure purchase loans up to 96.5% LTV.
So you only need a 3.5% down payment.
Exactly. And that is a massive, massive difference from 20%. If you're buying a $200,000 house, 20% down is $40,000. That takes years for most people to save.
Right.
3.5% down is $7,000. That's a tax refund and a few months of discipline. It opens the door to millions of people who would otherwise be locked out.
But the FHA isn't even the most aggressive.
No. The VA, the Department of Veterans Affairs, the USDA, the Department of Agriculture, for rural areas, they take the crown. They guarantee purchase loans up to 100% LTV.
Zero down. No haircut at all.
Zero down.
How is this possible? I mean, we just spent 20 minutes explaining that 100% LTV is incredibly risky. How can the VA do this without bankrupting the system?
Because of the guarantee. The government is stepping in as the ultimate guarantor. They're telling the bank, lend this veteran 100%. If they default, we've got your back. We will cover the loss.
That's a key distinction. It's not that the risk disappears, it's just shifted.
Right. It's shifted from the bank to the taxpayer. The bank is willing to lend 100% because their risk is effectively zero, thanks to Uncle Sam.
Okay, so that's the U.S. model. Now, let's hop over the Pacific to Australia, because their system has some really unique quirks.
Australia is fascinating. They use the term LVR loan to valuation ratio, but it's the same math. Their safe zone is the same. 80% or lower is considered low risk.
But they have this other tier for no-doc or low-doc loans.
Right. If you want a loan with less paperwork, maybe you're self-employed with a complex income, you need an LVR of 60% or below. Again, cash covers character. More equity buys you less scrutiny.
But what about the high end? The source mentions something about a guarantor solution. This sounds different from the U.S. government guarantee.
It is very different. In the U.S., the guarantor is the government. In Australia, the guarantor is usually mom and dad.
Ah, the bank of mom and dad.
Literally. They have financial products that allow for 100% LVR, no deposit at all, but only if a family member offers their own property as additional security. This is called a guarantor home loan.
So wait, I buy a house with zero money down, but my parents put a lien on their house to back me up.
Correct. The bank is lending 100% of the value of your new home, but they are securing it against two properties. The LTV across the combined portfolio is safe for them, even if your specific loan is risky on its own.
That is clever and emotionally terrifying.
It is. If you default, you don't just lose your house. You could cost your parents their home or at least a big chunk of their equity. It raises the stakes significantly.
The source calls this a nuanced approach. It balances access to homeownership for those with no deposit against financial stability. It solves the deposit problem, but it leverages the family unit in a very direct way.
It definitely highlights a different cultural approach to risk and family obligation.
Now, let's go next door to New Zealand. Because if Australia is using LTV to help families, New Zealand seems to be using it to fight a war,
A war against a housing bubble, yes. New Zealand is a great case study in macroprudential policy.
which is a fancy way of saying controlling the whole economy from the top down.
Right. In New Zealand, the Reserve Bank, their central bank, uses LTV specifically as a tool to cool down a hot market. The source specifically mentions what happened in Auckland.
Auckland was overheating, right? Prices were just
It
skyrocketing.
were. So the Reserve Bank introduced loan-to-value restrictions, and this wasn't a suggestion to the banks, it was a rule.
What were the restrictions? What did they do?
They told the banks, you cannot lend more than 10% of your total residential mortgage lending to owner-occupiers with high LTVs.
And they defined high LTV as having less than a 20% deposit.
Right. So imagine a bank issues 100 loans this month. The Reserve Bank said only 10 of those loans can be to people with small deposits. The other 90 must have 20% down or more.
That is a harsh break, though. It essentially forces the banks to ration those high LTV loans. They become incredibly hard to get.
It turns the safe zone into the mandatory zone for most people, and they were even tougher on investors.
Oh, tough.
For investors, they restricted banks to no more than 5% of their lending going to investors with less than a 40% deposit.
Wow. So if you want to be a landlord in Auckland, you basically need 40% down in cash, or you're out of luck.
Exactly. They used the LTV ratio to deliberately choke off demand. They made it harder to buy, which cooled demand, which stabilized prices. It shows the power of this number. It's not just a line on a form, it's a volume knob for the national economy.
That is wild. It's like a speed limit for borrowing. Finally, let's look at the United Kingdom.
The UK is a bit of a cautionary tale. Currently, they typically range between 60% and 95% LTV, with 95% being pretty rare. But the source mentions a historical warning.
The pre-2008 era.
The pre-economic problem era, as the source politely puts it. Back then, mortgages with an LTV of up to 125% were quite common.
125%. So you buy a house for £100,000 and the bank gives you £125,000.
Yes, you get the house plus $25,000 in cash to buy a car, go on holiday, renovate, whatever you wanted.
That sounds insane. You are starting the loan significantly underwater. You owe 25% more than the asset is worth on day one.
In hindsight, it looks very reckless. The assumption was that property prices would just keep rising and rise so fast that you'd be back in positive equity within a year or two.
They were betting on future appreciation to fix present risk.
Exactly. And we all know how that movie ended.
We do. Lenders stopped offering them in 2008. It's a stark reminder that LTE rules aren't laws of nature. They are choices made by institutions. And sometimes they make very bad choices. So we've toured the world, we've done the math, we've seen the traps. Let's try to bring this all together in our final segment. What does this all mean for the person listening right now, trying to make sense of their own situation?
I think we need to connect the dots between access and safety. There's a fundamental tension here that every country and every borrower has to grapple with.
Right. High LTV means access.
Yes. If you allow 95 or 100% LTV, you allow people with no savings, often young people, lower income families, to enter the housing market and start building wealth. That's good for social mobility. It's the dream part.
But it comes at a cost.
The cost is safety. High LTV loans are fragile. They are brittle. If the economic wind blows the wrong way, those borrowers go underwater very quickly. If enough of them go underwater at once, you get 2008. You get a market crash.
So low LTV is safety.
Low LTV prevents crashes. It ensures everyone has skin in the game. It creates a stable, resilient market. But it also locks people out.
No.
If you mandate 20% down everywhere, you're basically saying only people who already have money or wealthy parents can buy a home. It can entrench generational wealth.
That's the gatekeeper.
It is the gatekeeper. And regulators like the Reserve Bank of New Zealand are constantly turning that dial back and forth, trying to find the balance where enough people can buy homes, but the system doesn't collapse under its own weight.
And for the individual borrower, the borrower's dilemma, as we called it.
It's a very personal trade-off. A higher LTV gets you into the house sooner. You don't have to spend 5 more years saving that massive down payment while rents and home prices rise around you. But it costs more. You pay mortgage insurance. You probably have a higher interest rate. And you are under a microscope regarding your credit and income. You have less freedom.
Whereas a lower LTV offers freedom.
It does. If you wait, save up, and put 40% down, you get the best rates, you might get low doc options, and you have instant equity. You sleep better at night. But you had to wait 5 years to get there, and maybe the market ran away from you in that time.
So really, the LTV is a measure of patience versus risk.
That is a perfect way to put it. Your personal patience versus the bank's institutional risk.
Okay, let's wrap this up. We've covered a lot of ground.
We have. We defined LTV. We talked about the haircut, that crucial equity buffer. We looked at the valuation trap. Always remember, it's a lesser of the appraisal or the price.
We looked at the risk spectrum, the safe zone under 80%, the danger zone over 80, and that paradox that banks sometimes prefer safer assets over safer people.
We looked at CLTV, the stacking of debt. Don't forget the hidden risk in that HELOC.
And we saw how the US, Australia, New Zealand, and the UK all handle this differently, using LTV as a tool for everything from social engineering to economic warfare.
It's a global metric with a very local flavor.
So here is my final provocative thought. We talked about how those 125% mortgages disappeared in the UK after 2008. We look back at that now and we think, what were they thinking? Lending 25% more than something is worth. It seems ludicrous.
It does. It seems impossible today.
But here we are. 100% loans still exist in the U.S. via the VA and USDA. They exist in Australia with guarantors. We are still pushing that envelope. We're still trying to get to zero. So if LTV is the ultimate measure of risk, what does it say about our global financial mindset? That we are constantly trying to find clever ways to ignore the denominator. We keep trying to pretend the value doesn't limit the loan.
That's a powerful question. Are we really managing risk, or are we just getting better at shifting it around so we don't have to look at it directly?
Something to think about the next time you look at a Zillow listing. Don't just look at the price, look at your equity. Because in the eyes of the bank, that's not just money, that is your risk score. That's it for this deep dive. Thanks for listening, and we'll catch you on the next one.